looking at all-time low Treasury yields. Help our listeners figure out what the heck is going on, and why do you believe that now is the time where we hit this historical mark?
Well, clearly there are problems in the global economy. The credit markets are telling us a different story than the stock markets. They think that economic growth is very weak and likely to continue to be very weak. The stock market, on the other hand, at least in the U.S. where valuations are high, one assumes then that the market thinks growth is going to be somewhat reasonable. In my experience of 40 years, whenever you have that disconnect, it's much more likely to be true that the bond market is the correct forecaster. And the reason is the bond market is dominated by institutional investors where individuals can still drive stock prices. And what's happened here is the exceptionally low level of interest rates all around the globe. And with negative interest rates in Europe, they're all flocking here to buy U.S. Treasuries as well, driving our rates lower than they would be otherwise. What you've got is individual investors, particularly those who make the mistake of being what I call a cash flow investor. So they try to live off their interest income and dividends instead of a total return approach, which I know you and I follow and recommend for our clients. Those investors are saying, my God, I can't live on a 1% yield on my 5-year, bonds. So they're stretching and taking a lot more risk than they should, buying things like dividend-paying stocks, junk bonds, preferred stocks I see, people flooding to. And they forget that all of those things, if we get another bad economic event, like we had in 2008, will collapse. All of them fell 25 to 50, 60%, or even more in the case of things like emerging market bonds. So I'm very concerned that investors are losing discipline, and the Federal Reserve has thrown the savers under the bus in their efforts to try to stimulate the economy, which have not been successful, by the way.